Hello guys, if you are asking yourself what you should do in today's bear market, watch this video until the end. Enjoy. Don't forget to like and subscribe if you haven't done it already.
Well, I mean, my advice to them is what J.P. Morgan said when somebody said to him he can't sleep for all the money he's losing in the market, and what should he do? And J.P. Morgan said, sell down to the sleeping point. I mean, I think that's the answer. You know, it's funny you mentioned that because yesterday, I'm not going to mention the person's name for obvious reasons, but yesterday, a well-known money manager, one of the best in the world, redeemed our fund, and because he's got so millions and millions and millions of dollars, and we're like, really? So, but you know, that's I don't think he went out to buy a mega yacht or anything. I mean, I'm guessing he just was worried about how much money he's losing. The other thing that I've said is that nobody can predict these things, the future. No one has privileged access to the future. So could this be the end of days? Maybe it is. I don't know. Keynes made a point back in 1937 when the market went down 50%, and he made the point. Well, look, if you can't buy into the market when prices are falling and falling a lot, then you can't buy at all, because if it's the end of the world, well, it doesn't matter. But lower prices are always more attractive than higher prices. The most attractive prices are at or just close to the lows. I don't know if we're there or not in this, but I do know that with 6 new highs today and 2,000 new lows, there's a fair amount of pessimism in the market. Every correction that we've had in the past regime, so 2011, 2014, 2015, I think it was 2018, 2020, those particular lows were reached when we had about 40% of the S&P 500 making 52-week lows. So yesterday, I think we had 25% of the S&P 500 on the new low list, but another 25%, actually more than that, are within about 1% or 2% of making new lows, which would tell me that any sell-off from here, we're down what today? We're down 1.3% today. So, did we get a bad day tomorrow, a bad day Monday? We'll be, in my opinion, based on the previous lows, we'll probably be there or close to it, at least for an intermediate term rally. Well, for somebody who's been doing this for over 40 years, it feels familiar. There have been many cases when I've been through when it's been much worse than this. But still, this is painful. There was a line from Jesse Livermore's Reminiscence of the Stock Operator, where he talked about losing money and saying, he always considers losing money a valuable experience because you learn something from it. And he said, so he doesn't think about it as losing money. He thinks about it as tuition payments in the school of the market. And I would just say that since November of last year, the tuition has been very high for me. A very expensive lesson. I think I should ask President Biden for some student debt forgiveness here for the tuition payments that I've made. But I'll just give you 2 examples. So the ARK Innovation Fund, the Cathie Woods Fund, which is very transparent. I think yesterday, it's probably up today. I haven't looked at it, but yesterday it got down to where it was in March of 2020. So at the lows there, so it's lost all of the gains that it's had since then. The same, probably the 2 best records of people managing money professionally are Dennis Lynch at Morgan Stanley and James Anderson at Bailey Gifford, and both of their funds are down, I think, more than 50% from the highs just reached in November. So that's how bad the carnage has been in I'd say the disruptive innovation space. And then if you go over to the crypto space, MicroStrategy, Michael Saylor's company. So yesterday, MicroStrategy got down to where it was trading before he started to buy Bitcoin. And so it's given back all of the gains that it's done from there. It was like 160 or 170 yesterday, and it was, where was it, the peak 1,200 or something like that. So, and so clearly people are shooting at MicroStrategy and shorting it. And Saylor came out the other day when they asked him, like, what price would Bitcoin have to go to before you have to set, we're forced to sell it? And he said, well, the loan got from Silvergate Capital. Silvergate is a bank that operates mainly in the crypto space. Silvergate, by the way, in the $60 range, I think is an absolute bargain. But Silvergate loaned him the money to buy the last tranche of Bitcoin, $250 million. And he said he wouldn't have to sell any Bitcoin until it was $3,000. And where is it today? Close to $30,000. So it's got to get another 90% for them to have that. But that's an example. And I would say that the reason for that is, and this is probably the more important thing, is that we're in a regime change. You know, the inflationary environment, the environment that basically most people who are operating in the markets have seen since certainly the 09 lows, but really going back into the 1990s and stuff like that. I mean, this is, if you're of working age, meaning you're under 65 years old and you're in the investment business, you have never invested in a secularly rising rate and secularly rising inflation environment. And now I'm one of the few, Lee Cooperman's probably another, Mary Gabelli's another, that was of adult age back then. And I remember that period very, very well. And it's a different investing environment when you have secularly rising interest rates, the Fed tightening. You know, we have war in Ukraine in October 6th of 1973. I was in the Army at the time, and I was the duty officer when the Arab-Israeli war broke out, October 6th. So for our intelligence unit. So that's what kicked off that Arab-Israeli war. That's what kicked off the inflationary environment, just like the Ukraine thing kicked off the rising and the oil environment over there. So it's a replay of that, and it took 10 years finally for Paul Volcker from 79 to 82 to engineer, a severe recession. We had a recession in 73, 74, but that was part of a come down from the Nifty 50. One decision stocks, which peaked in December of 72. Our version of those, the disruptive innovation stocks, peaked in November of last year, and they're suffering a similar decline to what those Nifty 50 stocks suffered in 73 and 74. I mean, lower prices, other things equal, are always better than higher prices. If you're actually an investor and you're going to own stuff, for the long term, I would say that there are periods like, this was 08, 09 was like this, 73, 74 was like this, 1982 was like this, 1987 after the crash was like this. You don't get these opportunities that often. I'm just looking at, we own Citibank. Citibank got like about $70 tangible book value, and today it's $45. So the tangible book at Citibank is pretty tangible. And it's pretty I just say predictive of most banks, if they're accounting in their capital. So the tangible book value is a reflection of the underlying value of those assets, which are mostly liquid. No, I would say that the anxiety for me comes when, I can always tell when the market is close to a bottom when I get margin calls, because I read, despite what Buffett and Munger talk about with respect to borrowed money. My view is that if you can borrow money at negative real interest rates to buy productive assets, that you should do that. But I've gotten margin calls here, and that's painful because you have to sell stuff that you do not want to sell, and just to do that. But then, once the things are sold, and you also have to pay tax then. So I don't like to pay tax any more than the next person does. So my cost basis on Amazon is effectively zero. My cost basis on Bitcoin is effectively zero. So selling those things to meet margin calls, because they're also highly liquid, is going to be very painful next spring, because I got to pay tax on that. I don't like these periods because of the tuition payments that I'm giving to the bear market, and it's been extraordinarily costly and painful. On the other hand, it's a much better time to invest right now. I'll just give you some examples that are just front and center today. So OneMain Financial is a subprime lender. It has an 8% dividend yield. It's secure, in my opinion, and it trades at 5 times earnings. And this is the perfect environment for them, where you have rising wages and rising inflation, so that their credit is getting progressively better because people are flush with cash. So it shouldn't be 5 times earnings; it should be 10 times earnings, in my opinion. General Motors is 5 times earnings. Every car they make is already pre-sold. And even Kathy Wood, the famous owner of Tesla, just started buying General Motors because Mary Barra's got the right strategy. Paul Jacobson, the relatively new CFO, is really, really good, and their margins will be increasing with electric vehicles. So I think that's cheap. I would say that this period is, I'd say the worst period was 08 and 09, worse than 01. And that was because, in 01, we'd come off a long run and had a runway ahead of us of beating the market. And so even though we were down a lot, we outperformed in 01. We underperformed in 07 and 08 and 09, if I remember correctly, or 06, 07, 08, yeah, and 09. And we'd lost a lot of assets and we had to lay off a bunch of people. So that was a much worse period than when we were still in the midst of a long period of outperformance, even though we were down. So this, again, we don't have that level of assets, and it's basically a family office with some publicly available vehicles, and I'm the largest investor in those vehicles. So they represent a pretty good proxy for the amount of money that I've lost, from the peak. But it's I'm not, I'm not too concerned about it as I was in 08, because basically we don't have people to lay off. And we don't have clients firing us right and left. That was more stressful to me than just losing money.
Thank you guys for watching. I hope you enjoyed. Don't forget to hit the like button and to subscribe if you haven't done it already.